What's going on, everybody? It's Stas here. Welcome back to another video. So today, like you guys saw in the title, we're going to be breaking down some growth stocks, 3 in particular that I'm looking to buy as we're heading into 2022. And I actually already own 2 of these stocks, and the one that I don't own, we're going to talk about at the end of the video. So make sure you guys stick on throughout. We're going to break down some fundamentals, some charts, financials, some numbers. You guys are going to find some value. So hit the like button, subscribe, check out my Patreon if you want all my buys, sells, call outs, morning update videos, plus more. And you all can get 5 free stocks from Webull, which, by the way, that's limited time, and 50 free bucks from M1 Finance, also limited time. All of those, the Patreon, the free money, are linked down below. And with that being said, let's get right into the video. So growth stock number 1 is DraftKings. And again, the first 2 we're going to talk about, DraftKings included, I already own, and the one at the end I don't own, which I'm being very patient with. I'm waiting for the right price. And that's the thing. In the stock market, you don't just buy any stock, at whatever price it's at. You have to be patient, right? So we're going to talk about that in a couple of minutes. But number 1 is DraftKings, and this stock, if you guys take a look at the 3-year chart, it's been demolished recently from $74 back in March 2021. Now it's sitting just above 30 bucks. So the stock is down. If you take a look at this chart right here, it is down about 60%. And whenever a company's down that much, it's worth taking a look at. Not every stock that's down 60% is a buy, but if the fundamentals are right, it might be a buy. And in this case, I already own it, and I do plan on buying more, so that should tell you something. So if you guys don't even know what DraftKings is, it's a digital sports entertainment and gaming company. The company operates through 2 business segments, business to consumer and business to business. The company's business to consumer segment provides users with daily fantasy sports, DFS, sports betting, sports book, and online casino iGaming products, which they actually just bought GNOG, right? Golden Nugget Online Gaming, in an all-stock deal. That was a couple months ago. And that company, GNOG, is very good. They're known for their iGaming products. So I think that was a great buy by DraftKings. And the market cap right now for DraftKings is $12.39 billion. As I'm making this video, it might be a bit different when you're watching the video. And their trailing 12 months of revenue is around $1.1 billion, just a little bit over $1 billion, meaning their price to sales is about an 11 right now, which is not ridiculously overvalued, but in the same breath, it's not undervalued as well. You know, it's kind of in the middle there, a little bit higher than usual with that price of sales. And if you guys don't know how to, calculate that, you pretty much take the market cap of a company, in this case, $12.39 billion, and you divide it by the last 12 months of revenue, which is about $1.1 billion. So 12.3 divided by 1.1, you're going to get about an 11.6 price to sales. So at this point in time, this company is down a lot, and I've been buying it over the past couple of months. At very different ranges. I bought some in the low 50s. I bought some just recently at $27, and I bought some in the 40s. So my average at this point, I believe, is low 40s, and I do plan on buying a lot more as we're heading into 2022. And if I just pop up this and show you guys some numbers here in terms of growth when it comes to DraftKings, you guys can see in 2017 they did $192 million in revenue. In 2018 they did $226 million in revenue. In 2019 they did $323 million in revenue, followed by $615 million in revenue in 2020. And in 2021, trailing 12 months, they've done over $1 billion in revenue. So they've pretty much doubled up what they did in 2020. So this company is growing at a massive rate. We're talking 90% from 2019 to 2020, roughly 100% from 2020 to 2021. And the balance sheet is looking pretty good as well. well. If I pop up the Yahoo Finance website right here, we can see total assets sitting at about $3.4 billion right now. Total liabilities are at about $700 million. So way more assets than liabilities, and I like to look at current assets over current liabilities. Those are due within 12 months, the current liabilities and the assets, current assets. 12 months, they could be liquidated very quickly, and they have cash, a lot of cash too. So if you look at current assets divided by current liabilities, it's very good. Their current assets right now are at $2.1 billion. Current liabilities are at about $500 million. So way more current assets than current liabilities, and their cash equivalents, and short-term investments, if they wanted to, guys, they can literally take their cash right now, $1.8 billion, and they could pay off all of their debt. Their total liabilities are $740 million. They can take 1.8 bill, pay off $740 mil, and they still have a lot of cash equivalents, and short-term investments left. So the balance sheet for DraftKings looks pretty good. And if it comes lower, guys, 20s, we're talking mid-20s, low 20s, I'm going to be buying this company left and right. So stock number one, pretty strong growth company, is DraftKings. Stock number two, if I pop up this chart, give me a second here, guys, is Google, ticker symbol GOOG. And like DraftKings, I also own Google, and this stock is not nearly down as much as DraftKings. Again, DraftKings is down about 60%. Google's not down not even close to that. It's actually down a whopping 2%. It's down 2% from the recent all-time highs, where DraftKings is down 60%. And the reason is because these are two completely different companies at completely different stages of their business life cycles. DraftKings is still getting off the ground. They're growing a lot. Google is still growing a good amount, but they're way more mature of a business, and they're a large, big tech company, and a lot of people own them, and there's very little short interest. So stocks like that, great fundamentals, great moat, they go up in price. And you guys know Google, they own YouTube, the search engine, Android, cloud, a bunch of big stuff when it comes to Google. Their market cap right now is a little bit under $2 trillion. They have a 28 trailing 12 months PE, which is not that bad at all. They're just a little bit more expensive than the overall market. I think the S&P's PE is about a 26, something like that. So Google, with the growth they have, pretty good PE there, and their trailing 12 months of revenue is, get ready for this, $240 billion. So they're making a crap ton of money on the top line and on the bottom line, and they've been doing very well. And like I said, I own Google. This is a stock that I've owned for a while. My average is under $2,000 per share. I've bought it under 2,000. I've bought it over 2,000, and this is one that I want to continue buying. And I think when I look at Google, the way I think about it is, guys, if this stock were to dip 10, 15, 20%, no matter what cycle we're in, bull market, bear market, whatever, recession, I'm buying more Google. I'm buying more Google. If it dips 10, 20% from its peak, that's all day for me. I'm buying it. So they're doing great things. And let me pull up the let's see here what I can do quickly. Let me pull this up so we can see some financials when it comes to Google, and you guys can see the growth that this business is seeing. So Google right here, if I show you guys their growth from 2011 to 2020, your socks are going to be blown off, right? You guys can see they did about $39 billion in revenue in 2011, and they just did $180 billion in 2020. So remember, we talked about the PE. It's a 28 PE, right? And companies that have more growth, they deserve a higher PE, right? A higher multiple. It makes sense, right? And I honestly think even though Google's at all-time highs right now, it's crazy that they're at all-time highs, right? Like a lot of stocks are in this crazy market. I think even though they're at all-time highs, their PE is not that bad considering the growth that they've seen. I mean, if you look at the growth, look at the second row right here, guys. Revenue growth from 2011 to 2020, it has been between 15 and 20%, sometimes 30%, 25% even. Most of the years, guys, they've been growing at crazy clips, and I don't think this is going to slow down. Sure, they might not be doing 30 to 40% revenue growth, but 15%, 20% over the next couple of years is very reasonable. So the growth is there. The PE is a bit low, in my opinion, for the amount of growth. And if it takes a hit, let's say the PE goes to a 20, 25 even, I'm going to be buying a lot more when it comes to Google. And if I pop up their balance sheet, give me a second here, guys. I mean, their balance sheet's probably one of the best in the markets, right? If I show you guys their balance sheet, let's go to balance sheet. Let's see how many assets they have. $320 billion worth of assets versus the $100 billion roughly in total liabilities. Let's see current assets versus current liabilities. Current assets, $170 billion. Current liabilities, $56 billion. Let's see how much cash they have. $136 billion cash equivalents. They could easily take that and pay off all of their debt if they wanted to. All the current liabilities and all the total liabilities in general. So they're a very cash-heavy business. We know that. Same with Apple, Facebook. All these businesses have a lot of money. They're essentially cash churning machines, right? So I'm looking to buy more Google in 2022. There's no doubt in my mind that I will be buying more of that stock, as it is arguably my favorite stock in the stock market, and I've been very vocal about that for a while here. If you guys have been watching my channel, and if you guys are enjoying this video so far and you haven't done so already, make sure to hit the like button, because now we're going to talk about the third stock, which I don't own, and I'm waiting very patiently to buy. It's ChargePoint, ticker symbol CHPT. ChargePoint develops and markets networked electric vehicle charging system infrastructure. That they're big in the whole charging infrastructure, right? And cloud-based services. The company enables the customers to locate, reserve, authenticate, and transact EV charging sessions. And you guys know this is not a secret. We're going more electric out there when it comes to vehicles, and you're going to need to charge them somewhere. And ChargePoint has built that infrastructure. They're going to continue building it. And the infrastructure bill that's being passed, it was passed already, that is very beneficial to companies like ChargePoint. So I believe now that it's down from $36 to $19, it's down 45%, the stock over the past couple of months. This is getting to a decent buy zone, but don't get it twisted. The market cap is $6.5 billion, and the trailing 12 months of revenue is $160 million. So the price to sales for ChargePoint is very high. So if you looked at price to sales, 6.5 bill divided by 161 million, that is what? Off the top of my head, I can't even do that math. That's a very high price to sales, and you may be thinking it's a bit overvalued, and you might be right. But with companies like these that have astronomical growth ahead of them, it's you're going to have to pay a premium. So for me, I'm waiting patiently. If this stock were to somehow get to a $15 price, 13, maybe I'm being a bit ridiculous. I don't know if it's going to get to 12, 13, but if it got to that point, let's just say hypothetically, in 2022, I would be buying left and right. Even at 15, 16, I'm going to be buying a lot. And that's kind of what I said in the beginning of the video. If you're patient in the stock market, you'll be rewarded, right? So I like ChargePoint a lot. If we pull up their numbers here, let's see. And mind you guys, this is a newer company, so they're not going to have crazy amounts of years to look at in terms of data, but I think they're well on their way to becoming a strong company. I mean, if you take a look at 2018, they did $62 million in revenue. Now they just did 146 in 2021, 145 in 2020. And 2021 is not even done yet. So they're still growing at about 50 to 60% year over year, which is solid. And if I show you guys, let me see if I can pull it up here. Do they have, let's see their balance sheet. I was actually looking at it before on Yahoo Finance. It didn't show me anything. It says Yahoo Finance Plus essential access required. So we're not going to look at that. But overall, this company is promising. It's still in the beginning stages, just went public recently, and I'm going to be a part of it. I'm going to be a part of it one day when the price is right, and I'm excited for that day because I've been an owner before. I traded it. The thing is, I traded it, right? I didn't necessarily buy it to hold long term when I was trading it, but if it gets to the right price, I'm going to be buying it for the long term. So if you guys found value in this video, hit the like button, subscribe, check out my Patreon if you want all my real-time buys, sells, call-outs, morning update videos, all that good stuff is on Patreon, link down below, or you guys can go to stocksurfest.com/Patreon. Make sure to also get your 5 free stocks from Webull, link down below. Get on that. It's limited time. And you could also get $50 bucks from M1 Finance, also limited time. All of that's linked down below. I'll catch you guys in the next video. I'll pop some up here. Check them out if you guys want to watch these videos. I'll see you there. Thanks for watching. As always, keep crushing the market. Stay safe out there. Peace out.